Welcome. Thank you for joining me. This is Steve Brennan, Managing Partner at Select Financial Capital. I'm presenting some information and data on the commercial real estate market in 2022. First off, going over the general state of the economy, GDP in third quarter came in at a positive read of 2.33% prior to any subsequent revisions. As many of you know, the first two quarters were slightly negative. Future revisions could actually possibly turn that flat or even slightly positive. But the very kind of basic definition of 2 quarters of negative GDP growth, it fits, although we really haven't seen the kind of weakness commonly really associated with recessions. But nevertheless, we have definitely seen some economic weakness this period. And despite the upturn in Q3, we continue to face some challenges in the economy and the market. The real story, though, so far in 2022 has been inflation and interest rates. Here you can see the consumer price index, commonly used index. The Fed also pays a lot of attention, though, to the PCE. Regardless of which measure you use, you can see a strong spike up in inflation rates this year. The response in terms of interest rate policy has been one of the steepest and quickest series of rate hikes in market history. You can see here on both these charts that, as well as one chart shows average rate on the 30-year fixed mortgage, you can see has really just kind of exploded upward to about 7%, from being down all the way at 2.5%. This other chart shows that 10-year Treasury yields have reached about 4%. The Fed funds rate, after a good period of time really being at the zero bound, really effectively at 0%, has really exploded higher. This has caused, in many cases, yield curve inversions, where the short end of the curve is actually cheaper than the long end. So you can, in effect, borrow money at a lower interest rate short term than what would you need to pay long term. This is often indicative of recession risk. And there is some concern with how fast the Fed has been hiking, that a year or so from now we could be possibly looking at recessionary conditions. Regardless, the impact on real estate of higher interest rates has been a negative, and we're going to take a look at residential real estate first. In terms of sales, not surprisingly, as financing costs have gone up, as interest rates have gone up, we've seen a real strong drop-off in residential home sales. People are just simply not selling their homes. Not surprisingly, also for buyers, having to now employ mortgages at much higher rates. They're being more cautious, and we're definitely seeing some folks who maybe own a home with a fixed rate mortgage just not wanting to swap out that low interest rate mortgage for a higher mortgage. So all these things have really impacted the residential home market, and we've really seen sales cool off quite a bit. The impact on prices hasn't been as severe, but we are starting to finally see that impact the market. We saw quite steep price increases during the whole COVID pandemic. With the change in interest rates, though, we've just for the first time really seen price declines, most recently getting reported. And this is the Shiller Home Price Index. But whether you look at the composite index or the 10 city or the 20 city, they're all showing the same thing. Other data is also showing the same thing, that residential prices nationwide have actually started to fall a bit after some very steep price increases. This is generally, according to most economists, most market observers, and ourselves, really linked to what we're seeing in terms of financing costs and interest rates. I wanted to now turn to the commercial real estate market, which is really more of our focus. And what we are seeing there is that this market has done quite well in terms of generating returns. We've seen price increases. We really haven't seen a tremendous amount of weakness so far across sectors. Here you can see the return environment has been quite healthy so far, in 2022 after another very healthy 2021. You can also see here that although investment has come down, it's still at very healthy levels from where it was previously, although we would expect this to potentially come down even a bit further given the interest rate conditions we're seeing, as well as some of the concerns we're seeing about the economy going forward. Turning to the property price index, here we can kind of get a sense for different parts of the market, different segments, and how they've been performing. The real kind of winner here has been industrial, which has been for quite a while enjoying very strong price increases. It's definitely the most popular part of the market and one of the most expensive parts of the market. Multifamily is not too far behind in terms of price increases. We can see here that retail has definitely been weaker and office has been one of the least performing segments, certainly the least performing major segment in the commercial real estate market, with the smallest year-over-year price increases of only at 10% for office in general. One of the advantages of real estate, including commercial real estate, when we're not talking about like residential primary homes, is the income production and the inflation protection, the ability to increase rents provides. It can actually make real estate, if you are in a higher inflation paradigm, an attractive asset class. Data here shows that we already are seeing real estate react to the higher inflation environment by increasing rents and therefore increasing revenue coming in. Turning to cap rates, what we can see here is that all those price increases for industrial and also for multifamily or apartment have had the impact of really reducing the income generation coming out of those sectors. They do right now have the least attractive cap rates. On the other hand, office being less favorable, less attractive to investors, actually has the better cap rates with retail in between. In mortgage production, we can see here that there is definitely weakness in the commercial real estate market. We can see on the CMBS side, a real pretty strong drop in terms of production of mortgage. So we're definitely seeing an impact from those higher interest rates and some concern about the economy in terms of buyer activity and financing. Turning to the 2023 forecast from investors, we can again see some of that negativity creeping in, as many respondents, about half of them, have expectations for falling revenues. So the outlook definitely has become more negative. In North America, it's about 43%. So not quite as bad as, say, Europe, where they're struggling with a lot of energy issues associated with the Ukrainian conflict and whatnot. But we can definitely see on a global basis as well as a US basis a little bit more pessimism in the market. For us, of course, we look at all this sometimes as potentially creating buying opportunities. If we can find an asset that's been marked down or an opportunity where there's maybe some mispricing going on there. Investment outlook, the survey of investors found that office ranks as one of the commercial real estate markets looked upon most favorably as far as where you could potentially get the best risk-adjusted investment opportunity, the best mispricing opportunities, with office downtown at number 1 and office suburban at number 3. Sandwiched in between those two is items related to the digital economy, as that's continuing to see expectations of growth going forward. Here we're just going to take a look very quickly at a few of the major segments. Here we can see some of the areas experiencing some of the fastest rent growth when it comes to multifamily. A lot of these are areas were favorable towards. Miami, Florida, close, of course, an area where we have invested with multiple properties. Tennessee, Charleston, South Carolina here, Orlando, Florida here, Greenville, South Carolina, Fort Lauderdale, Indianapolis, Indiana, where we're recently looking at a property, but a lot of business-friendly and Sunbelt states. We're seeing increases as rents, partly as more people come into those areas. We have seen migration trends towards the Sunbelt, towards some of the more business-friendly states, and that does seem to be getting reflected in the multifamily market and the rent environment that we're seeing. We remain positive on business-friendly areas. We remain positive on Sunbelt in general. Here, turning to the office market, we can see that absorption has remained relatively flat. We separately recently provided a separate presentation really focusing on the office market and what we're seeing between different segments there, from metros to different classes. But we can see that in general, office absorption has been relatively flat. Here also, the chart shows some of the areas with the strongest absorption and some of the areas with the slowest absorption. Industrial, this chart spotlights again strongest and slowest absorption for the industrial category. For us, like many segments, we're continuing to focus on areas that we look upon demographically as positive, business as positive. And then on the retail side of here, again, we see absorption and we across areas and by category. I would point out that although a lot of people kind of classify the retail almost along with malls, the categories themselves are very, very different. We've certainly seen a lot of weakness in the past in terms of the mall category, but that weakness hasn't really generally bled over to other segments. That concludes a quick look at the commercial real estate market in 2022 as of October.